what we're going to do is we're going to walk through every major peak since the 1970s and actually show you that 75% to sometimes more than 100% retracements are not only the norm that to be expected. This was 2022, and I'm going to walk through this one with a little bit of detail, but then the rest of them just going to kind of fly through because it's all essentially the same thing. But what we're looking at is we have these divergent highs, and if clients that were with us back in 2022 know how well the whole risk gauge process did, getting us more and more defensive into this decline, and perhaps most importantly, kept us defensive in these rallies. It didn't turn bullish until this rally. So it did a great job in this window of time. What we can see here is that we have this big decline. This is the 40-week moving average, which is basically the equivalent of the 200-day average, and you have a 75% retracement back across the range. And this did nothing to fix the risk gauge. It was still broken. It was broken down here, deteriorating up here, broken down here, and did not get fixed on this rally, which led us to the same conclusion. This rally was a 20% rally, and very similar to today. The short-term risk gauge went to risk on. The other two gauges stayed actually, by the time this happened in this particular market, the two longer-term risk gauges were actually in risk off. And on this rally, the short-term gauge went into risk on, yet the two long-term gauges stayed in risk off. So this was just a perfect short opportunity. And so this is how the whole process works. And this is where I think we are. We have something that's very comparable to this. And I'm not saying that this is going to happen, but I am saying that if this is going to happen sustainably and robustly, we need to fix some things first. And given that we've rallied, we're now back to overbought. If we didn't fix anything, this is just a better sell than a buy up here. So moving on, 2018, same idea, divergent high. In this particular case, we retraced the divergences began in here. We had another new high and it was divergent again. So this was a divergent high that actually retraced more than 100% of that last decline. So this is all the more tricky because you got yet another high, and this is not uncommon. And I'll show you a couple more examples. 2015, highly divergent, retraced almost 100%, then rolled over into another massive decline in the market. And this was one of the largest volatility spikes in history. 2007 and 8, this was a real tough one. Highly divergent, retraced more than 100%, and then rolled over into the global financial crisis. And if you want to learn and refresh your mind how the risk gauges function throughout this particular window of time, we wrote an entire video on it. It was the November monthly motor checkup, and it was called When Turkeys Fly. So if you want to see this in greater detail, you can go back and watch that video. 2000 was also really tough. I would argue it was even tougher than the GFC in terms of how it played out, but highly divergent, retraced more than 100% of the decline, and it just got more and more divergent of epic proportions, which I'll show you in a moment, later giving way to the unwind of that entire internet bubble in a 50% decline in the market. So new highs did not fix the structure, did not fix the breadth, did not fix the leadership, and so therefore it failed, giving way to the bear market that followed. So this is the 1998 peak right before long-term capital management. And what looks to have happened here, in fact, it is what happened here. If you're looking at this shell, this particular shell, you would think that you just went on to a new bull market. Now, if you've been watching our videos and following our research, you know that that's not at all what happened. This was one of the most divergent windows of time in history, up until the current one that we're in right now, which I would argue is more divergent. This was the most divergent in history. So the question is, was this actually a bull market? What I've shown repeatedly, and I'm just going to quickly show again here, is here's that 1998 divergence. Here's the long-term capital management decline, and here's what appears to be a resumption of the bull market, leading us today to think, are we right here? And we're about to do this. If you're able to fast forward with perfect foresight, what you actually come to realize is that ended up becoming one of the greatest divergences in history up until the one we're in right now. And of course, this whole divergence led to that peak that I just showed you on the preceding slide that led to the ultimate unwind of the internet bubble. Now, if you're looking at this and you're thinking, man, this chart looks awfully familiar. It should, because it's exactly what we have today. Same thing. So this is just not. It's almost annoying. It's frustrating, but these are the cards we're being dealt. And I'm just trying to at least encourage myself and to anybody that wants to listen, that you need to focus on this shell, because this is the shell that matters. This shell here is a lie. This is the one that the street vendor wants you to pay attention to while it's picking your pockets. This is the truth. And this is what I'm trying to keep focused on myself and trying to keep my clients and readers focused on as well. Going forward, 1990, highly divergent, went out to new highs. So it's like a nested divergence, like a repeated divergence condition, went out to new highs and then gave way to the bear market that coincided with the Iraq War. 1974, very divergent environment, retraced 50% of the preceding decline, which is actually the smallest retracement of all these markets. It's been anywhere from 75% to more than 100%, and the one we're in right now is more than 75%. So this is actually the smallest divergence we've seen of all of the major market top rallies. And then 1968, again, very divergent. This was the Nifty 50 era, highly focused, highly concentrated, very similar to today, very similar to 2000. This one retraced 75% before giving way to roughly a 50% decline. These are the conditions that are actually normal. This is what it looks like when you're putting in a major top. And I think if you're focusing on the wrong shell, you're going to fall for it. And I want to stress that I'm not saying that the market won't be able to save itself. We need to keep an open mind. But these conditions that I'm following are inviolable. You can't have a sustained, robust bull market without these things fixing themselves. So we're now back across the range and overbought. So now we're just broken and overbought. This is the worst place to pile in. And if you ask me at the margin, it's the best time and place to continue to build a defensive position, whether it's raise cash for tactical investors, raise cash and consider to slowly, patiently get short. And then more for the longer term investors who are not tactical, who will ride out whatever bear market comes, use this information to prepare your mind for the possibility of a decline in the market. And when you start to get a decline in your favorite strategies, start to take on water, if you will, and you still have confidence in your strategies, use that moment to add to that strategy because that's how you improve the long-term returns of being in that strategy over time. Buy it when it's down. It's like buying a really expensive sweater when it's on sale in the heat of the summer. So those are the two mindsets to adopt. If you're tactical, start to get defensive, maybe layer on some shorts. If you're long-term trend following or you're a long-term investor, this is just not a good place to load up on stocks. And further than that, it's a good place to prepare your mind. And if you're an advisor, this is a great time to prepare the mind of your clients for the prospect of a decline and get them starting to think about buying that sweater when it goes on sale. Thanks so much for watching this clip of the monthly motor checkup video. We appreciate your interest in our research, and we hope that you are finding it helpful and informative. If you'd like to continue watching this video, as well as access our most recent monthly motor checkup, sign up for a free 30-day trial to all of our research at motorcmr.com. You'll find a link to our website in the description below. As always, like and subscribe to be notified of future content.